Hello, and welcome to our webinar, Preparing to Thrive in the Recovery, Cash Flow, PPP Loans, and Alternative Capital. My name is Sherrill Corbett. I'm a partner in the business department at Tonkon Torp, and I'm today's moderator. Our hope is to provide you with practical advice for your business on how to survive this pandemic and thrive during the recovery. If you have questions unique to your business, we invite you to reach out to our panelists directly or the Tonkon Torp lawyers you normally work with to discuss your specific situation. Today, we will hear from 4 panelists. Don Bielen, a principal of Perkins Co, a locally owned accounting firm in Oregon. Drea Schmidt and Jeff Cronn, both experienced partners in Tonkon Torp's business department. Tonkon Torp is a Portland-based full-service business law firm providing comprehensive legal advice and litigation services to individuals and companies at every stage of growth. And finally, Brian Murphy, President and Managing Director at Meridian Capital, a Seattle-based middle market capital sourcing and mergers and acquisitions advisory firm. Let me pause for a moment and make a note about the format today. This webinar is being recorded. You do not need to sign a disclosure and no private information of yours will be shared. Please know, however, that if you choose to participate in our Q&A module, your question may be recorded in association with your name. The webinar format does allow you to ask questions. Feel free to submit them in the Q&A section of your Zoom app. I will do my best to ask each panelist a few of the questions as they come up. We want to be sure, though, to have time for all of the panelists, so if I don't ask your question right away, please wait for the end. We will conclude with a Q&A session, and we'll try to hit as many questions as we can. We also welcome any feedback you may have after this webinar. If there are topics you want us to cover, please tell us. We hope to be a source of information for our business community throughout this challenging time and plan to hold additional webinars going forward. Finally, this information is as of today, April 23rd, and is not intended to be legal advice for your specific business. Please contact your Tonkon Torp lawyer or one of the panelists for specific advice pertaining to your situation. So let's get started with the program. Let me turn it over to our first panelist, Don Bielen, who will be discussing how businesses can manage cash flow during the pandemic and the recovery. Don, what strategies and tools should business owners consider to manage cash flow and preserve capital in these uncertain times?
Well, thank you, Sherrill. I appreciate the opportunity to share my thoughts on how business owners can position their company to emerge stronger from this crisis. Just a couple opening thoughts. Virtually no business, I believe, will escape the current crisis without being impacted. Some businesses may even experience a fundamental change to their business model and not really realize it. And the natural tendency for most business owners while in crisis is to focus on reducing expenses and conserving capital. And I believe this makes perfect sense since cash is king and liquidity under these conditions is critical. But I believe it's also important to distinguish between crisis management, which we're currently in, and strategically positioning the business to recover and looking at the mid and long range positioning of the organization. Of course, crisis management is basically financial triage to stop the bleeding, and it's a natural first response. However, we can't overlook the need to strategically position the business. And what I mean by strategic positioning, strategic positioning is really geared to help the business to heal and prepare for the recovery. It does, in essence, defend the revenues and protect the long-term viability of the business. So back to strategies. We believe that it's important from a strategic standpoint to start and look from a top-down perspective. It's high-level planning and it's very driver-based. So what do I mean by driver-based? There's basically 2 drivers when you look at the business, is the revenue drivers and the cost drivers. So when you look at the revenue drivers, for example, under the changing market conditions, it's important for the business owner to take a look, what's the impact on product pricing? Maybe your sales mix. What's going to happen with customer demand? How do you modify your service offerings? Then what are the other areas that may have fundamentally changed in the marketplace? Then you have to look at your cost drivers. What's going to happen with your raw materials, your overall cost of goods sold? What are some of the disruptive forces that impacted my supply chains? So once you have the revenue drivers and cost drivers, then of course, those are going to be very specific to each business type. So by example, a commercial real estate firm is going to experience something very different than a manufacturing company or maybe a material supply company. So as an individual starts to assess strategically how their business has been impacted, of course, you have to look at the very specifics that are related to your type of company. So once these drivers have clearly been identified, the next step, and I'll touch on this here momentarily, is to create detailed cash flow projections and model various high-level scenarios under various driver assumptions. Sherrill?
So Don, what is your recommended approach and process to do this?
Yeah, I mean, big picture, according to McKinsey Quarterly, you might have seen this, scenarios help you ask the right questions and prepare for the unexpected. So we believe that it's very important to create detailed monthly cash flow projections. These projections should include the detail of, for example, derived from an income statement, what's happening with your balance sheet on a go-forward basis, and then, of course, those two items impact and create your cash flow statement. So then you have to also develop the supporting schedules, such as your debt schedules or your asset schedules. So we believe that it's important to build out, even if, like, for example, a 13-week cash flow model, and depending on the business, is to revisit it as frequently as weekly. And then once you build your cash flow projection, then it's important that you, based on this base case, you create alternate business scenarios. So for example, you might model a fast recovery scenario. So revenues are going to be robustly growing. You might have some improvement in your cost structure. Second scenario might be a moderate recovery. So that could be more of a status quo model. Then I think it's important that you would model maybe a slow recovery. So revenues lag, but you have fixed and variable expenses that will also continue and could dramatically impact profitability. But what's important, what we found when we go through the scenario analysis, it's important to equally weight each scenario and spend equal time on each scenario, because we have a tendency to develop a bias towards what we believe is going to happen. So we believe that once you create the scenarios, then you can create the cash flow models. Then you'll ultimately get an idea of what's happening with operating cash levels, what's happening with working capital, what's happening maybe with your PP&E in terms of timing your capital purchases, and then bottom line, looking at what's the impact on your long-term assets and liabilities. That could then cause you to take a look at your lending arrangements, or maybe your operating leases, or it's going to look at your capital stack in terms of how you capitalize the business. So I believe, bottom line with scenario analysis is that you need to do this type of analysis to make really high quality decisions on how to structure the business and position it to recover faster and more effectively from this crisis. Sherrill?
So Don, a question for you. What if a business doesn't have a CFO to help them with this cash flow modeling process? Who do you recommend they can talk to?
Well, I think there's many resources to go to. Of course, one may be to your local accountant or maybe a financial, a firm that does corporate financial analysis. I know with Perkins in our organization, we have a variety of different groups and teams that have this capability. We've had to adopt what we've done typically and historically, looking at long-term 5-10-year type forecasts, but modifying that to accommodate these conditions. So I think it's bottom line, it's either your accountant or maybe an operational type organization that does consulting, or maybe more of an outsourced CFO type organization that could be a good resource.
Okay, so getting back to creating this cash flow forecast, can you give some examples of these key business variables that you need to evaluate when creating that forecast?
Yeah, absolutely. Well, I think you have to look initially on the macro basis. So what are the economic growth rates in your particular marketplace? What are forecast, what are anticipated? What's happening with the supply and demand for your product in the marketplace? What kind of pricing pressures are out there relative to competition? You have to look, of course, as I touched on, your raw material cost, your supply chains. Also look what's happening with maybe consumer spending habits and patterns. There's going to be some fundamental changes to obviously what we've seen within grocery stores, eating establishments, even I guess consumer products companies, distribution companies, you name it. And then also then what is the ultimate market size and your market share? So those are, I think, the macro external drivers that you'd want to evaluate. Then I think then based on that, you have to look at some of your business variables. You know, what is my access to capital? What can I do to tap into my existing resources? Do I need to look at alternate forms of capital? And that's where Brian might speak to that today. But also then what's happening with your cost of goods sold, your ultimate gross profits. And then back into the micro is what's happening with your fixed expenses. Maybe there's certain expenses that are just going to be totally eliminated. And then of course, you're going to scale the business. So your variable expenses are going to be in line with what's happening with revenues. But you can't then finally overlook the impact on your workforce and employee productivity. I mean, remote working has probably changed a lot of companies' business model in terms of what is produced within the time that's allotted, and looking at different ways to structure your organization to increase productivity, maybe change incentive programs, or even modify compensation structures that would be different than what you traditionally did. So those are the main things that I think we look at, macro and some micro.
So Don, business owners often ask in this environment, if they have untapped lines of credit, do you have thoughts on whether they should be accessing those now?
Yeah, the general consensus that I'm hearing from a number of business owners is that since liquidity is so critical and cash is king, is to talk to your banker, be very proactive, try to maybe expand your operating line if you can. Some individuals, as opposed to taking operating line, might be seeking some term debt, and maybe like a 90-day term debt, by example, that is going to be very flexible, accommodate the very low interest rate environment. You may even stretch the terms of some of your existing debt and renegotiate that. So those are the type of things I think it's very important to be proactive with your banker and see what type of flexibility and options that they have for you.
Thanks, Don. The last question I have is, can you give us a summary of the key steps in this cash flow and capital management process?
Yeah, good. I thought as a takeaway, number one is when you look at your business is to find your key measurements and the related time frames and the issues. That may be a given, but it's more of a process. Number two is also, as we touched on, is define your key business drivers. What are the key inputs, i.e. revenues, i.e. costs, that are going to determine the free cash flow and the overall strength of your balance sheet and your working capital. Number three is you have to go through a process and collect and analyze your data. Number four, I think it's very important that you, as we've touched on, develop and model your scenarios. Some individuals struggle with doing any sort of forecasting because they're concerned, they're trying to predict the future. Scenarios are not crystal balls. What you're trying to do with scenario planning is compare the impact of changing assumptions on your base result. So scenarios are very revealing in terms of determining almost the correlation between certain assumptions and the results. Number five, I think it's very important to interpret the results from each scenario, and then you develop action plans and contingency plans. So under each of the scenarios and the results, if there's issues that are identified, is talk specifically with your team on developing what our organization is going to do to counteract those conditions that we may find ourselves. So in essence, you're developing this contingency plan and a plan of action that you can put into play very quickly. Number six, I think it's very important to communicate with your key stakeholders. That's internal stakeholders and external stakeholders. With your employee group, talk about what's happening. The future of the business is probably a lot of anxiety. With external people, again, your lenders, your suppliers, your customers, your main key stakeholders that really drive the business. And then finally, just like any sort of plan, I think it's very important to monitor what you've put in place and then update the scenarios periodically, because we're in very dynamic times and you're going to have to continue to keep your financials and your assumptions in sync with what the economic reality is. So those are the 7 key steps that I suggest an individual consider when doing their cash flow and capital management process. Sherrill?
Thanks, Don. That was very helpful. We will turn now to Jeff and Drea, and they will be discussing the Paycheck Protection Program loans, which are commonly known as PPP loans. So Jeff, Drea, I'll start with you, Jeff. Can you give the attendees a bit of background on the PPP loan program and tell us how the implementation has gone, as well as where we are with it now?
Thanks, Sherrill. The answer to the first part of your question is a bit complicated, and the answer to the second part of your question has been changing daily, and in fact will likely change again today. First, I think some context. In fiscal 2019, the U.S. Small Business Administration's primary lending program for small business, which is known as 7A loan program, approved 51,907 loans with a total value of $23.2 billion. So that's U.S. fiscal 2019. The CARES Act containing the Paycheck Protection Program, or PPP, became law on March 27th and allocated $349 billion to the program, or approximately 15 times the total value of 7A loans approved by the SBA in all of fiscal 2019. The SBA began to accept and approve the first application for PPP loans on Friday, April 3rd, 1 week after passage of the CARES Act. The SBA then announced that the entire $349 billion allocated to the PPP had been committed as of April 16th. So in a period of 2 weeks, 4,975 lenders wrote 1,661,367 PPP loans as approved by the SBA, with an overall average loan size of $206,000. Locally, the Oregon story, there were 18,732 PPP loans approved in Oregon, totaling approximately $3.8 billion. So to your question, was the implementation successful? There are many stories in the media now about PPP loans that went to public companies, private equity-backed enterprises, and others who arguably did not need them. I think notably Shake Shack, Potbelly Sandwiches, Ruth's Chris Steakhouse have been in the news quite a bit. There are other stories about many lenders who favored their current lending clients, leaving some small businesses without pre-existing lending relationships out in the cold. These are certainly fair criticisms and, to a certain extent, inevitable outcomes of a significant new governmental program implemented in a week on the fly, literally hours after the initial publication of program rules. The rush to implementation and funding was meant to achieve the program's primary goal of getting as much money to borrowers as soon as possible in order to attempt to save jobs. I think, not surprisingly, implementation was imperfect. Having worked to help clients through the loan application process every day during this period, there were definitely systems and process failures. Lenders in the SBA were also at times overwhelmed by the demand from small businesses for the uniquely favorable loans. From and after the passage of the CARES Act on March 27th, the general consensus has been that Congress will need to allocate additional funds to the program. And on Tuesday, the Senate passed the bill to allocate an additional $310 billion to the PPP. The House is scheduled to vote on the legislation today, and I expect that the President will sign it into law immediately if and when passed. So for potential borrowers who are listening, if you have already applied for a PPP loan, but it has not been approved by the SBA, contact your bank to see if they still have your application and whether or not it will be submitted when the SBA begins accepting new PPP loan applications. If you have not yet submitted an application, gather your information and get your application ready. Contact your bank and be prepared to apply as soon as the SBA announces that there are funds available for new PPP loans. And with that, turn back to you, Sherrill.
Thanks, Jeff. So can you remind folks what the loan can be used for and what portion of the loan can be forgiven?
Yeah, so the answer to those questions are quite a bit less complex and also quite a bit shorter. So PPP loan proceeds may be used for payroll costs, mortgage interest, rent, utilities, and interest on pre-existing debt. Up to 100% of a PPP loan may be forgiven, which is core to the favorable loan terms that I described earlier. That forgiveness is subject to certain provisions that may limit debt forgiveness, and Drea is going to touch on those provisions next.
So Jeff, we have a question from an attendee. Is there more detailed guidance on loan forgiveness calculations?
It's been promised. It has yet to be provided. Loan forgiveness is going to be a focus through the June 30 loan forgiveness calculation period. The SBA and the Treasury have been focused on a constant basis on PPP detail definitions of things like payroll costs and other details necessary for the application process, and they have yet to get to further guidance on loan forgiveness. What I will say is that there is quite a bit of guidance that is necessary to define a number of provisions that are partial and some that conflict.
Okay, Drea, can you talk about the portion of a borrower's loan that is eligible for forgiveness? Can it be reduced, the part that's eligible for forgiveness?
Yes, and so just to tick off of what Jeff was saying a little bit, for most small business owners at this point who have been approved, the first big hurdle in this process was to get the application accepted and actually get funded. But as soon as that happens, borrowers really need to shift gears and start focusing on getting their loan forgiven, because now the clock is actually running. And what I mean by that is that the requirements for forgiveness include 4 key components that if a borrower does not meet these 4 requirements, then the amount of their loan proceeds that can be forgiven is reduced. And first is that the loan proceeds need to be used within the 8-week period that follows origination of the loan. And so that means that once the funds or any portion of your funds hit your account, your 8-week period that is specific to your business starts to run. And so you need to make sure to use all of the loan proceeds within that 8-week period in order for the loan to be forgiven. The second big requirement that folks are going to be focused on is that the SBA did come out with a rule that said that at least 75% of your loan proceeds need to be used for payroll costs. So the specific things that Jeff talked about, payroll costs is one component, but then there's also mortgage interest, rent, and utilities. But 75% of your loan proceeds need to be used for payroll costs. And if you don't use 75% of your loan proceeds for payroll costs, the amount that is less than 75% will be reduced from the amount of your loan that can be forgiven by the bank. The last 2 requirements that I want to talk about that can reduce your loan forgiveness deal with maintaining your full-time employee headcount and maintaining salaries. For your employee headcount, you need to make sure that during the 8-week period that's applicable to your loan, your average number of full-time employees is not less than your average number of pre-crisis employees. And there are specific calculations, specific time periods that you have to look back at to compare to. A business has an option to look back either to the period between February 15 of 2019 and June 30 of 2019 and figure your average number of full-time employees, or to look back and compare to the period between January 1st of 2020 and February 29 of 2020. If your number of average full-time employees is reduced over the 8-week period, your 8-week loan period, compared to one of those prior periods, then the proportion of your loan that can be forgiven is proportionately reduced. So for example, if you reduce your employee headcount by 10% during the 8-week loan period, then the forgiven loan amount is also reduced by 10%. The salary requirement with respect to employees that earn less than $100,000, the amount forgiven will be reduced by the amount of any reduction in salary or wages during your 8-week period to the extent that it exceeds 25% of the employee's salaries or wages as compared to the most recent fiscal quarter. Now, importantly, for both of those requirements, there is an exemption. If you rehire all of your employees to the number that you had during the comparable period by June 30th of 2020, and if you restore salaries to your pre-crisis level salaries, again by June 30th of 2020, then your loan forgiveness amount will not be reduced. Sherrill, back to you.
So Drea, we have a couple of questions from attendees on this loan forgiveness piece. On the 8-week calculation, does it mean that they have to have incurred the cost or actually made payments during the 8 weeks?
So that's a big question, and the way that the statute reads, it says that forgiveness is available for costs incurred and payments made, but we don't know whether that means that the costs need to be incurred and the payments made, or whether that is an either or. Because of that uncertainty, and we do hope that the SBA will give us further guidance, but because of that uncertainty, in order to maximize the chances that you will have as much forgiveness as possible, we are advising folks to first prioritize any costs that are both incurred and paid within the 8-week covered period.
Okay. Another question on this: do payroll costs include benefits like medical, dental, retirement?
They do. Those are included in the forgiveness amount. There are specific calculation requirements with respect to each of those components, but those pieces are included.
Okay. So what practical advice would you give a borrower in order to maximize the amount of loan that will be forgiven?
So there's one really key thing I want to point out here, and that is that both the law and the SBA rules and the guidance that govern loan forgiveness, they were written really quickly. In some cases, they are unclear, and in some cases, they are actually contradictory on many specific conditions of forgiveness. For that reason, we absolutely expect the SBA to issue some additional clarifying guidance, but the key takeaway for business owners on this call is that the guidance, including some of the things that we're discussing today, potentially could change, And for that reason, it's really important to be informed and to be as prepared as you can be to respond to some of the changing guidance, which is what we've seen so far, and we expect more of that going forward. So to that end, I have 5 practical tips for borrowers as you think about moving through the forgiveness period. First, designate a PPP point person. So have one person at your organization be responsible for following what's going on with the PPP. This is the person that is going to be staying in contact with your lender, keeping up on the news, and also potentially keeping in touch with your CPA and your attorney to keep up on everything that's happening and making sure that you are in line in a really good position to have your loan forgiven. Second pointer, record keeping is the name of the game for forgiveness. We don't know exactly what every lender or what the SBA is going to require you to show in order to obtain forgiveness, but we do know that you need to be able to prove that you use the proceeds in a permitted way and that you satisfied all of the remaining requirements. So you used the proceeds within the 8-week period. You used at least 75% of the proceeds on payroll costs, and you had the required number of full-time employees and you maintained salaries, or you are eligible for the exemption from those requirements. So get organized early and stay organized throughout the process. Third tip, time is of the essence. Again, keep in mind, you need to use all these proceeds within the 8-week period following the funding of your loan. So for many of you who have already received a loan, that time period has already started to elapse, so you need to be on top of that. Number 4, prioritize payroll. As I mentioned, you need to make sure that at least 75% of your loan proceeds are used for payroll costs. So make sure that you are first allocating your loan proceeds to payroll costs just in order to maximize that portion of your loan forgiveness. And the last point that I would make, and I think this is really key, is that borrowers need to stay in the loop with their lenders. The rules and the guidance that are coming out that's really what's going to drive forgiveness of these PPP loans. But keep in mind that your lender is the one that is going to be interpreting these rules and all of the guidance. And your lender will also be putting together programs, and potentially they will be developing the documents and the document requirements that are going to dictate what you need to submit in order to achieve forgiveness. So with that, I'll turn it back over to you, Sherrill.
Thanks, Drea. So Jeff, are there other federal and state funding programs available to business owners who do not receive or aren't eligible for a PPP loan, or if they need more help?
Yeah, thanks, Sherrill. The PPP program is unique because of the loan forgiveness elements that it contains. It's not like any other government lending program that I've ever seen, and understandably, as there's potential for significant forgiveness of this debt on what is a non-taxable basis under the statute, borrowers or potential borrowers are very excited about potential participation in that particular program, but it's not the only program that's available. Certainly, it's been the focus over the last several weeks, but there also are available economic injury disaster loans. It's a historic SBA program. It's available across the country for businesses negatively impacted by COVID-19. This program is currently out of money also, but with the pending legislation, there's a proposed allocation of an additional $60 billion A portion of it goes to grants, which essentially are not repaid, and then loans of up to $2 million at an interest rate of 4% or less, and with a loan term of up to 30 years. So that's another good option. It's not exclusive. PPP and the disaster loans can both be taken by a borrower. CARES Act also creates what's called the Main Street Lending Program, and this has been a bit more on the back burner, but will move to the front burner here before very long. This program is for small and mid-sized businesses, including borrowers that have received PPP loan amounts. There's up to $600 billion of funding for larger loans at an interest rate of 2.5% to 4%. There's initial guidance out on the program from the Fed, and there have been a deluge of comments on the program as written. Those comments are being taken into consideration, and the expectation is that there will be further guidance released by the Federal Reserve and the Treasury coming days and weeks. Also, just mention there are many additional city, state, and local resources as governmental institution after institution looks to address COVID in their community. Good summary of these resources is available on the Tonkon website. There's a COVID-19 resource section that will point to resources available from a variety of jurisdictions and private entities. A couple of external resources that I think are worth noting. The Business Oregon website, there's a long listing of resources available to small business. Also, the Greater Portland website, easy to find in both of those websites, the COVID-19 resources. And with that, Sherrill, I'll wrap up and pass it back to you.
Thanks, Jeff and Drea. We still have quite a few questions on PPP loans that we'll try to get to in our Q&A session. But moving on, we'll turn to Brian from Meridian to discuss alternative capital. Brian, can you provide us with an update on the current capital markets? How has COVID-19 impacted mergers and acquisitions and growth capital transactions?
Thanks, Sherrill. Glad to be part of today's discussion. In general, capital markets and M&A transactions do not respond favorably to things like uncertainty and lack of visibility. And so as you can imagine, with the uncertainty related to the overall economic impact of COVID-19, the uncertainty regarding the time to recovery and what that recovery curve will look like, and then obviously uncertainty or lack of visibility over how business performance will look on a case-by-case basis over the next 6, 12, 24 months, has essentially put a halt or significant delay to a majority of transactions that were in market as of February and early March of this year. Based on conversations we've been having with our peers in the market, lenders, private equity firms, and companies, our estimate is that somewhere around 75 to 80% of transactions have either been put on complete hold indefinitely, or at least delayed for 30 to 60 days as various investors look to gain that additional visibility that will allow them to reach the finish line. Some transactions, the ones that are continuing in that minority 20% range, tend to be very industry specific. So some of the industries that you may expect are holding up better or more resilient to the current crisis, such as food supply chain, the defense and military industries, healthcare services, or technology companies that support remote work solutions or cybersecurity. Those transactions, some of them are getting across the finish line, but again, it tends to be very industry specific and a minority of the transactions. The reason for this is, again, I mentioned the uncertainty, but also there's a significant distraction in the market right now for the lenders and private equity firms as, if you consider it, the 5 to 8 years leading up to March when the pandemic started was some of the most active, high-volume M&A periods where there were record valuations, record leverage being used or debt being used on these transactions, and portfolio sizes and number of companies that were owned by private equity firms and heavily levered were truly at record levels. And as a result, all those investors and all those debt providers have portfolios of 50, 60, 100 companies where they're rapidly trying to identify the impact of the current crisis, which loan covenants are likely to be broken, which companies will likely need emergency cash infusions, whether that's debt or on equity. And that distraction, or focus, I should say, is really preventing the assessment of new investments. I'd say the silver lining to this is that since this crisis happened so quickly and the downturn happened so quickly, there are still record amounts of undeployed capital or dry powder cash held by private equity firms, debt funds, and in many cases, public companies to make investments. And as these companies get a better feel and more visibility for how their existing portfolio or operations will likely perform over the next 6 to 12 months, they, by definition, will want to put this capital to work in some way. So what we've already seen is the conversation shifting away from the majority transactions at record valuations from early in Q1 to conversations where private equity firms, sub-debt providers, and alternative capital providers are reaching out to firms like ours and saying they are reallocating a meaningful portion of their funds away from majority buyouts or full transactions, full sales, to situations where a company might need bridge capital, might need minority capital to buy out a shareholder that needs liquidity, or would like to pursue an offensive strategy to pursue maybe M&A opportunities going forward. So we believe that there will likely be at least a 30 to 60-day continued lull in the market as some of these debt providers and private equity firms do additional research on their existing portfolios. But given the amount of capital in the market, transactions will likely begin getting done in Q3 and Q4, but what those transactions look like will likely change away from the majority full sale transactions to more bridge capital and minority transactions to support either increased liquidity or aggressive growth plans for companies that are looking to capitalize on the disruption in the market. Sherrill?
So right now, what forms of alternative debt and equity capital are available for businesses, and what are the key considerations?
Yeah, there's several forms of alternative capital, and again, these are solutions we're helping our clients with, where if the net earnings of your company, the traditional lending channels such as the large banks, the Wells Fargo, B of A's, Wells Fargo, or the stimulus programs are not providing enough liquidity either for defensive or offensive measures. These are the forms of capitals where that are typically more aggressive, a little bit more expensive, and also a little bit more flexible. So the main ones you'll likely be hearing about are, as I mentioned earlier, the non-bank private credit funds, or you might hear the term business development companies, BDCs. Mezzanine debt and bridge financing providers, private equity firms that focus on minority or growth capital investments, and then family offices that are looking to pursue some combination of those three buckets. Very quickly, the non-bank traditional senior bank lending, cash flow lending, this market is driven by stability of cash flows. They tend to have interest rates in the 6 to 9% range, as opposed to traditional loans that might be closer to 2 or 3 to 5% today. And as I mentioned earlier, this group was severely impacted by the current crisis because they had put out a lot of debt at very aggressive multiples over the last 2 to 3 years. So we think this capital will likely be on hold again for the next 60 days, but will become available again in Q3 and Q4. The mezzanine debt and bridge financing market, this market we believe will be more open. This is debt that is typically subordinated to senior lending, does not have securities against it other than stock, typically has a cost in the 10 to 14% range in terms of current interest payments, but has significant flexibility in that they're interest-only payments and there's no principal payments due until maturity, which is typically 5 to 6 year term. Although when you start getting into mezzanine debt, the governance rights and the desire to have a board seat and have slightly more, I'd say, operational or hands-on control of the business becomes a factor. And then as we move into equity solutions, this would obviously be the most flexible forms of capital. Most equity solutions don't have any current pay or interest requirements associated with it, but the expected return over the life of the investment is obviously more than debt. They're looking for upside equity or ownership in the business. So from a preferred equity standpoint, where investors would be looking to be front of the line when a business is sold. The return preference there is typically in the 15 to 18% range. And for more common or non-preferred forms of equity, private equity firms or family offices are often looking for 20% annual returns. And also in this case, you start seeing a lot more requests and demands for governance rights, minority rights, things like call and put options that give options for repayment. And the last bucket I mentioned, which we think will become more and more comfortable, is family offices. So these are wealthy families that have created funds within their family to make investments. We think this type of investment will become more and more attractive over the next 2 years because these families will be less attracted to things like bonds, public markets, fixed return profiles that have become less attractive over the last year and specifically over the last 60 days and be seeking outside returns. So we believe you'll see a variety of family offices coming in with private capital looking to make these minority investments, growth capital investments, or mezzanine debt investments in private companies. Quickly, in terms of factors to consider, we think obviously how much capital you need and how much you can raise is a big consideration, but there's several non-economic factors that we think are equally important. There's 4 that I've listed here. The first is how much flexibility do you need and what is the trade-off to the cost of capital. So depending on the cash flow visibility you have in your business in order to pay off the loan, if you are concerned about the certainty of that cash flow, obviously you want a more flexible solution and may lean more towards a mezzanine debt or private equity solution where there's no current pay requirements. Governance and shareholder rights is the second consideration. Depending as you move to more flexible types of debt, the shareholder rights, board rights, and governance controls that investor will require will become more and more stringent. And you'll want to know what type of partner and what type of governance rights you'll have as the ongoing majority investor and who your new partner will be. What type of value add capabilities can that investor provide? So a lot of these debt providers or private equity firms have very strong industry knowledge. They have operational capabilities, whether it be helping build out a supply chain, help with lean manufacturing, and many of them can often bring customer relationships into the fold based on the industry experience they have. And so there's potential to add value add relationship goals outside of just the capital in a transaction. We believe that's something that should be considered. And then lastly, what is the investment horizon and the partnership horizon in an agreement? So if you take on a 30% partner and you continue to own 70% of the business, but you'd like to continue to be the owner of that business indefinitely, several of the investors will be looking for their money back over a 3, 5, or 7-year period. So looking at the options and the ability to transition the relationship 5 years down the road and how you could either refinance or repay that money to continue to own your business is another important consideration. Sherrill?
So it sounds like there are a lot of different alternatives. Should business owners, one of our attendees asking, should business owners also be considering asset-based lenders during this time?
I certainly think that should be a consideration. I'd put asset-based lenders more in the traditional lending bucket. So within a traditional bank, such again as a Wells Fargo or B of A or Key Bank, they will have term loans, they'll have asset-based loans, ABLs, and they'll also have revolvers. Again, those are typically the most attractive forms of debt in terms of the cost of capital and the need to repay and I'd say the ease with which to get. That said, the alternative forms I'm talking about are typically for the companies or business owners where those ABLs, revolvers, solutions may not be available.
Another question, Brian, from an attendee is, how would you suggest a business owner access these alternative forms of capital? How would they tap into these sort of resources?
So these resources tend to come from private funds, whether that's credit funds on the debt side or equity funds. Typically, although someone could attempt to do it via their own private research, via a Google search, you could certainly identify some of the more prominent investors in your specific industry. When you get into the alternative forms of capital and you start having to do some of the more sophisticated or complex cash flow analysis and cost of capital analysis to determine which solution is best for you, that's where a firm like ours or another M&A advisory firm can become useful. We maintain relationships with hundreds, if not a couple thousand of these private funds that focus on different situations, whether it be minority or majority, different situations in terms of whether it's groups looking for a $5 million check or a $30 million check or more, and can help also in terms of finding partners that have industry-specific knowledge. And so truly, if you're looking to pursue an alternative capital or debt solution, we'd recommend the use of an advisor to understand the landscape.
So moving on to our last question, Brian, what proactive steps should business owners and management teams be taking now to best position themselves to capitalize on the market disruption investment opportunities?
Yeah, quickly, we really see this happening in three phases, and we created something based on the lessons learned from the previous recession in 2008 to 2010 called the Toolkit for a Proactive CEO. Phase one is a lot of the items that my former panelists have mentioned today. So that's more of a defensive phase. So phase one, over the first 30 days, doing your cash flow analysis, doing your stress testing, capitalizing on stimulus programs. But pretty quickly, as you get into month 2 or 3 of a crisis, we believe companies should look at the potential opportunities to capitalize on this disruption or dislocation in the market, or potential misalignment among shareholders. And so what we mean by that is look out 1 to 2 years and determine if you think, based on your position in the market, there may be opportunities to take market share via acquisition, via more aggressive capital investment plays, and based on that, what forms of alternative capital might be useful in pursuing those goals. And so we really believe being proactive in your strategy and also being proactive in terms of preparing your company to be able to capitalize on opportunities that arise is important. So we recommend that companies begin having conversations with potential private equity firms, family offices, mezzanine groups, not telling them that you're going to market or that you're definitely going to raise money, but having conversations, see what terms are available. So if an attractive M&A opportunity does present itself in the near term, you're able to capitalize on it. Because typically, if you're trying to purchase a company at the same time running a capital raise in order to raise the funds to purchase that company, it's too much going on at one time and you'll miss the opportunity. So that preparation, we believe, is very key.
Thank you, Brian. So that brings us to the end of the panelist portion of our program, and we can go into our Q&A session. So for attendees, feel free to stay on while the panelists answer some of the questions posed by the attendees. Drea, we have a couple of questions here that are similar. On the payroll costs, should a business owner open a separate account to document the payroll payments?
There is no requirement that businesses open a separate account to hold their loan proceeds, but that is one great way to add a layer of documentation to very clearly show that you have used the loan proceeds on permitted purposes. So it's a great idea if you can do it.
Yeah, so it provides sort of an automatic audit paper trail to show where the money was used.
Yeah, absolutely.
So another PPP question. Since our application was based on the prior year average, what if we do not incur the total amount of the loan for qualifying costs? I know it affects forgiveness, but do we need to return any unused funds?
Is that question directed to me, Sherrill?
Yeah, you were Jeff.
So if you need to use all of your loan proceeds for qualifying purposes, regardless of when you use the loan proceeds. But and if you use it during the 8-week period for qualifying purposes, then that portion is forgivable. But let's say that a business doesn't have enough expenses during the 8-week period to use all of the loan proceeds. They can continue, they can keep the remainder of the loan proceeds and repay them as a loan at a 1% interest rate that is due after 2 years. None of that portion that is used after the 8-week period will be forgivable, but just keep in mind that you still need to use 75% of that loan on payroll costs, and you need to use it only for the permitted purposes for the loan.
Thanks, Drea. So Brian, we have a question from an attendee. How have providers of alternative capital been able to assess the impact of the severe financial downturn on a business that they're considering investing in? And are they willing to take more risk?
Yeah, that's a good question. I'd say in the near term, what we've seen is that alternative capital providers are still trying to figure out how to properly assess the risk profile. And so their immediate reaction has been to significantly reduce the purchase price if it's an equity provider by 30 to 40%, we've seen in some scenarios, and for debt providers to essentially back out of the process. However, in the last couple of weeks on new opportunities that have remained in market, we've seen debt providers assess the risk by, instead of maybe lending 3 times EBITDA debt multiple, bringing it down by half turn or full turn to 2 to 2.5 times, so providing less capital, and then also increasing the price of the debt by around 200 basis points. Or 2%. And then as it relates to private equity firms, they are often coming in and asking for a preferred capital or equity position, meaning they would get their money out first or get some minimum return before the rest of the capital structure is paid out. So those are the mechanisms they will likely look to use.
Okay, so this will, I think, be the last question because we're getting to the full hour here. Either Drea or Jeff, this is regarding a PPP loan question. I won't be able to use all of my PPP funds on payroll. Can some of the funds be used to pay owners for their loss of self-employment income? And there may not be a clear answer here.
Yeah, Cheryl, this is Jeff. I'll jump in on that. So we've spoken nicely about the clarification from Treasury and SBA of the act and implementation that occurred so quickly. So some of the clarification, in fact, changed the provision of the act. So more change than clarification. But one of the clarifications, as written, the act severed self-employment income from the business payroll costs and took the view that self-employed individuals, for example, partners, partnerships, members of limited liability companies with a material equity piece, should file for loans separately. Subsequently, the SBA changed that view and provided that self-employment income of partners, LLC members, were in fact included in the definition of payroll costs and should be considered both for purposes of maximum loan amount and for purposes of calculation of forgiveness. So the answer is, assuming you have the type of self-employment income that becomes included, which again, LLC members, partners, and others, then that compensation capped at $100,000 annualized would be included for purposes of calculating forgiveness.
So it is in the definition of payroll costs then, based on the guidance?
It's not in the Act, and it is in the guidance.
Thank you for clarifying that. So we've come to the end of our program, and thank you to all of our panelists for participating. If we weren't able to get to your question, or you have questions particular to your circumstances, we invite you to reach out to our panelists or your Tonkon Torp lawyer that you normally work with. I hope you found this valuable and invite you to watch for additional webinars planned in the coming weeks. Thanks for attending.